When we sat with Fed Chair Jay Powell this week at the Economic Club of New York, we talked about what he has learned about the economy over the last 3 years, about inflation and its connection to labor, and what may be lasting in the effects of the pandemic.
So hindsight is always a wonderful thing, right? I think the fair way to judge the actions that were taken is to put yourself in the place of legislators and policy, and central bankers around the world. And there was no playbook. We hadn't seen a global economic shutdown. People were thinking that the pandemic might kill a whole lot of people and that we wouldn't have a vaccine for 5 years. We might not have an economy for 5 years. So these things were all very possible in March of 2020. And so we pulled out all the stops and Congress pulled out all the stops. With the benefit of hindsight, could we have done a little bit less and had a little bit of inflation? I guess we could. But I think if you look overall at the performance of the U.S. economy, our economy is the strongest. We're actually also making the most progress on inflation, but we certainly have the strongest growth. We're back to prior growth trend, not just level of where we were. We're actually back to the prior trend. The labor market, the last time we had this many consecutive months of unemployment below 4% was in the late 1960s. So it's more than 50 years ago. So our economy is doing very well from all of that. But if you had perfect hindsight, you might not have had as much inflation if we'd done less. Although other countries who didn't do as much as we did also had substantial inflation problems.
So let's talk about the labor market. You referred to that in your remarks as well. And as you say, vacancies have come down some, although they still are pretty elevated, if I'm not mistaken. Quits have actually gone up some. It seems to be a tight labor market. What do you make of what's going on in the labor market right now?
Labor market has been extraordinarily strong. So what happened in the pandemic was we had a negative labor supply shock, is one way to think about it. So a whole lot of people left the labor market when the pandemic happened and then didn't come back. And so when the economy reopened and everybody, there was revenge travel and revenge everything, very strong demand, and there just weren't the people. So you had 2 job openings for every person actively seeking employment. We've never been anywhere near close to that. There was panic, and wages and bonuses, and particularly in things like in-person services where people had not gotten big wage increases and didn't want to come back to work. So that's where we were. So since then, there are very many signs that the labor market is getting back into balance, and I talked about some of that in my remarks. Surveys of work, we survey businesses. We don't do it, but other people survey businesses and say, are workers plentiful? And that measure was no, but now it's back to pre-pandemic levels. You survey workers, are jobs plentiful? And that was at an all-time high, and now it's still high, but back. So wage increases are coming back down to more normal levels. Job openings are down from 2 to 1.4. They were at 1.2 in the very tight labor market of 2019. The work week, by so many measures, the labor market is gradually cooling. And part of that is this, all through 2022, we thought we were going to get more labor supply, and we didn't. And I personally thought, well, I guess we won't get any. And then we've gotten a substantial amount this year. The female labor force participation is in prime age workers is at an all-time high, which has to be related in some way to work from home. But labor force participation increased, immigration increased, and now you see that in the overall cooling of the labor market. So even though job creation is still very high, there are the workers to fill those jobs. And again, businesses will tell you that it's very different. It's still a very tight labor market, but it's loosening.
Coming back to your goal of 2% inflation, what have you learned from this experience about the relationship between inflation and labor? I mean, there's a lot of talk about a Phillips curve, whether it still applies, whether it's weaker, what is it? What's your hypothesis right now with the relationship between inflation and labor market?
Well, let me tell you what it was before. So one of my favorite charts is just the slope of the Phillips curve over 40 years. And so it shows the relationship between unemployment and inflation. If you go back to the high inflation of the 70s, it was a very tight relationship. And that relationship went down and down and down to the effect where the Phillips curve, there was almost no relationship, meaning the Phillips curve was very, very flat. Now, actually, if you just ignore cause and just look at the data, it will tell you that the relationship is back. Do we really think that's a sustainable thing? I don't know. What happened though was that people came to seriously expect 2% inflation, something like 2% inflation. And if people expect that, if companies expect it and workers expect it and you expect that in your shopping, then that's what'll happen in a way. And that's what happened. So even in very, very tight labor markets, we didn't have high inflation. I was at the Fed since 2012 as unemployment went from 6 to 5 to 4 into the 3s for the first time. And you know, the models were all saying that we should be seeing some inflation, and we never really saw 2% inflation on a sustained basis during that era. So we learned that the Phillips curve was really flat. Some pronounced it dead. Now, I don't think most of the inflation we're seeing at all is from the Phillips curve, though. I think it was really the collision of very strong demand, really strong demand, with constrained supply. Cars being a great example. Many people wanted cars, didn't want to ride public transportation, wanted to move to the suburbs. Unlimited demand for cars. Interest rates are low. Yet we couldn't get semiconductors, so there are no more cars. Car production went down. How do you solve that problem? Prices just go way, way up for cars. That's how you clear the market. So that's a classic example of what happened here. It really wasn't about the Phillips curve. It was more about constrained supply and demand more broadly, especially for goods at the beginning.